Right. Good afternoon, everybody. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Here is the position disclosure. It's the same as yesterday. Okay. Dare I say we had a little bit of a quieter day today? It was an inside day, I think, across the board for SPYs, Qs, and IWM. It wasn't exactly slow. It was slow in the beginning of the day, and the Russell stayed slow all day. SPYs are up 1% here. Qs are up 1%. IWM's up 1%. TLT, where's my quote? There it is. TLT down 1%. Interest rates are higher. The dollar is getting destroyed. So look, we had an inside day today. Not surprised to see it. This market was super oversold yesterday at lows. I think we're well aware of that. The ranges yesterday were crazy. Even today, being an inside day, is an $11-12 range in the SPYs. So, like I said, on the one hand, it seemed like a little bit of a quieter day, and it was an inside day, and again, this IWM range was a bit tight. But on the other hand, still an $11-12 range in the SPYs, which is pretty big compared to what we saw when we were at huge positive gamma levels, right? So market was able to give a little bit of a relief snapback today. It is an inside day. Inside days are important, these rest days, because they can act as setup trading sessions for the future. So there is an opportunity here for bulls and bears. The bearish argument is that you have an inside day after we broke to new recent lows, so it's consolidating the weakness, and then that enables these moving averages to catch up and trigger another leg lower. The bulls would say the inside day is a setup here where if you can get the inside and up, it could become productive. That could lead to a little bit of a bigger bounce in the market. But in order for this market to actually get healthy again, it's got a lot of work to do. You really need the SPYs to negate the candle from 2 trading sessions ago. You really need these SPYs back above the $297 to $600 area in order for us to look healthy again. We're all the way down at 582.50. There's a lot of work that bulls need to do to improve this market. And even if they gave an inside and up tomorrow, which would be productive, it would help. It's just further giving a price correction of downside extension at this point, which technically is actually still shortable and is technically still bearish until and unless you're able to clear those big upside levels that we discussed. So for the moment, I do still have my bear hat on. I am still bearish on the market, but we have to be strategic. And with where we opened today, we said, it's just not a good day to do a lot. Granted, we were opening at $10 of extension to the downside in the SPYs. In a normal market environment, I would be interested in buying $10 of extension after we got a doji day yesterday. In the current environment, the key on any longs has been patience. Patience made us money on February 25th longs. Patience made us money on February 28th longs. Patience made us money on yesterday's longs. Today, I said, yeah, we're $10 extended. Normal market environment, I'm interested in buying it. This market environment, I would rather miss the move than be too early. And, I didn't really do a whole lot of new buying today, and I didn't really capture the intraday upside on anything new, and I'm just fine with that. I do still have swing longs on. Yesterday I got to 100% long into the close today. Oh, I did add a position. Never mind. Where's my position? Where's my disclosure? I added 2 positions. What am I talking about? Sorry. Palantir T triple Q. Yesterday into this move, I had gotten 100% long out of all my shorts, out of the Q short, out of the Palantir short, and then I bought SoFi, I bought PayPal as more than day trades. I bought Google, Meta, T triple Q, and shorted UVixy all as day trades. They all worked out really well. And today at these price point levels, there just wasn't as much for me to do until we really started bouncing back. So I started shorting some Qs again at like 245. I know technically we were making a bullish consolidation there, but the confines of the bigger picture, I wanted to get some shorts back on, and I thought maybe there was a chance we could get one of those afternoon rollovers, not as big as yesterday, but maybe some selling that we're talking about this morning maybe was coming a little bit yesterday from a few factors, but the leverage ETFs being one of those. Those leveraged ETFs acting as like a negative gamma, and then they're rebalancing into the close can sometimes create some of these pushes. So thought maybe we could get that. We didn't. But I'm happy to kind of reinitiate a TQQQ position that at this point is not very big. So certainly giving myself room to add up on that. Oh, excuse me. Certainly giving myself room to add up on that if and when we bounce back further into this equilibrium zone, or potentially to add to it if we, bear flag out here and these moving averages catch up a little bit. I'm keeping my bear flag, my bear hat on for the moment until we start to see some better information come from the market dynamics. Just pulling up Pat's note again this morning because there was some really important information in there. So this morning, one of the additional factors I'm not shorting this morning, and potentially you could use it as a reason to buy, short-term tactical in the green, short-term composite below 10 at 3.4. It's like the lowest I think I've seen it, though we only started looking at that relatively recently. But this Goldman note right here, this line, CTA supply intensifying post yesterday's week close with 39 billion of U.S. equities set to be sold over the remainder of this week. And when they say yesterday's close, I actually think they meant Monday's close on that, just based on the timing of when this comes out. So, but basically that would be $39 billion worth of selling in U.S. equities over 4 trading sessions. That's like $10 billion a day. That's a massive, massive, massive number. It's one of the biggest numbers I've seen on the weekly basis, I think, ever since I've been monitoring some of this CTA data. And I just can't turn bullish for anything more than an oversold bounce in extreme extension with this, knowing that this degree of selling is in my face. That's not to say that we can't go up. There's lots of other flows in there. For example, corporates are buying. Corporates are indeed buying this dip as our desk executed flow is currently running at 1.3x last year's daily average. So the companies themselves are coming in and they are buying the dip. But long shorts have been selling and have room to continue to sell. That CTA number is just outright scary. I'm not 100% sure what retail is doing at this time. Obviously, they're pretty big on being out of the money on some of the heavy buys that we had seen in January and February from the retail cohort. Maybe they're coming in and buying the dip at this point, I'm not sure, but at a certain point soon, there's a good chance that they're going to actually have to do some tax selling as we get towards tax day in mid-April. So, big picture here, I do think that there is a chance for us to... This mid-March is going to be interesting, this March 14th, because that is typically the day where the flows switch again. One of the things that made us get bearish at highs here was an understanding that coming into the back part of February and February OPEX, it's historically met with outflows after a month and a half of inflows. January, first half of February is actually like the biggest buying period of the year historically, and then that gives way in the second half of February to selling. So it's one of the things that we were looking at. That tends to flip again on March 14th, where we get inflows that come back into the market. That coincides, though, with a potential government shutdown over the budget that I think needs to get passed by that date. So it's going to be interesting as we get to that March 14th, because there's a potentially a catalyst on either side here. If they pass the budget and the buy flows, just naturally come in as part of that cycle, we could at a minimum start to see some stabilization from the market. Stabilization could give way to vol selling, which creates a further underlying bid and begins a little bit of a of at least a short-term healing process for this market. The flip side is if they fail to pass the budget, that could be just the next catalyst that begins to drive us lower. And then I think quarterly OPEX, I think, is March 21st, I believe. So, could get a catalyst starting in front of that OPEX, which would be interesting if it plays out that way. So we'll see what happens as we get closer to mid-March. But for the remainder of this week, for me, it's very hard to be a bull for more than looking for that short-term extension bounce, even though I am net long right now. Just in the face of that 39 billion CTA selling number that I mentioned. I mean, that's just a wildly, wildly big number. So, yeah, I mean, for me today, the game plan with where we opened was to take a little bit of a less is more approach. I said into a big bounce, I'd be interested in reshorting. Like, I want to be at least within $5 of the ADMA to consider reshorting, is what I was saying in the morning meeting today. Normally, I actually want more than that. But with the environment, with that CTA number, I'm actually willing to be a little bit looser on that. So, $5 the downside extension is like 582.50 to 583. We basically finally, only into the end of the day, got into the area where I would consider beginning to put on some reshorting. Hence me putting the Q short back on. Hence me putting the Palantir short back on. And it was only into a much deeper sell. We almost got there that I'd be interested in buying. The SPYs really did, actually. The SPYs gave you an opportunity to buy versus yesterday's low. I didn't take it because I was being a little bit more QQQ focused. I wanted more like 490 in the Qs to begin buying. So I never really pulled the trigger as the low was 491.26. But the SPYs, if you were just going based on the SPY, it actually pulled deep enough there for you to consider starting to do some buying near lows today versus yesterday's low. There was enough extension off the downside tail from yesterday that I felt it was a good trade, but I didn't pull the trigger on it. I honestly, I still traded a decent amount today, but I've been trading like an insane amount recently. So I traded like a third of what I traded yesterday, and it was primarily position management around my swings, and then reinitiating Palantir and the Qs at a certain point. But it actually felt good to almost have like a little bit of a rest day today from just how heavy my own trading has been as the market gave us an inside day and begins to kind of reset up. So I think that describes both my thought process for moving forward and kind of the day a little bit and what I did. I am happy to answer any questions that you guys may have. Just logging into the YouTube on my other screen. So first in the VTF from Pete, when you are determining how many points a stock is trading from equilibrium, are you using the closest EMA to the stock regardless of if it's the 8 EMA or the 21 EMA? So I'm usually looking at the 8 EMA. Most of the time the 8 EMA is closer. Once in a while, when there's a very quick move in the other direction and the moving averages haven't had time to cross yet, then the 21 EMA can be closer. That happens a significant minority of time. I don't know what percentage, but I would guess, maybe 5% of the time you could be looking at a 21 EMA that's closer to the price action than the 8. Maybe a little bit more than that if you're thinking about the market just being in equilibrium. But if we're talking about extension specifically, you have to have such a big move to create extension where the moving averages haven't crossed yet that it's relatively rare. When that happens, I still look at the 8 EMA as my measurement, but I also recognize the nuance of the picture in that situation. Would be the best way that I would kind of describe it, because it makes it a little bit more nuanced. For example, stock is trading at $30, the 8 EMA is at 40, and the 21 EMA is at $45. Yeah, that's normal. So I'm looking at it versus the 8 EMA, Um, so I would say that it's $10 extended from the lower band of equilibrium. And then I would say that it is um, $15 extended from the upper band of equilibrium. And that's your range. So, $10 extended from the lower band of equilibrium, that's primarily what I'm looking at. But we also, in heavily trending stocks, pay attention to the spread between the 8 and 21 EMA. Because when that spread widens enough, then a lot of times the bounce back to the 8 EMA isn't enough. You're looking for a bigger bounce back than that, more like the midpoint between the 8 and 21 EMA. So again, it's a little bit nuanced. There's not like a clean answer to this because it depends a bit on the situation. But broadly speaking, measuring it to the 8 EMA, which most of the time is going to be the closer moving average, but the equilibrium zone is the space between the 8 and 21 EMA. So using your first example here, I would say we're $10 extended from the lower band of equilibrium, or $15 extended from the upper band of equilibrium, and also paying attention to how wide that spread becomes as the stock itself actually moves. Also, of your total trading, how much would you say you do percentage pre-market? I really don't know. It also probably depends on the day and if there's any pre-market events that are ongoing, but less than 10%. Um, Most of what I'm doing most of the time pre-market is just managing positions per my game plan. Um, for most of my swing game plans, if a stock is at a certain price that I'm supposed to buy or sell at, I don't care what time of the day it's happening. Pre market, post market, during the market, my game plan says I'm supposed to buy or sell. The exception to that is I don't do much risk adding after hours. So what I'll tend to do after hours, one of the things I do between 4 and 4:10 p.m. Eastern is I put out limit orders per my game plan that are risk off limit orders. So, for example, if I'm short Palantir and my game plan says that I'm supposed to cover some stock at 89.50, I would typically have that bid out at 89.50 to reduce after hours risk and book profit. But I typically don't add risk after hours because I'm not here to manage it. I turn my computer off at a certain point. So I'm fine if I get filled on bids that are booking profit and reducing risk after hours and I'm not there to manage it. That's fine. But I don't want to be having a news event go against me and I'm getting filled on orders that are adding risk in a swing position when I'm not there to manage it. So, like, if my game plan right now says I'm supposed to buy some Palantir at 89.50, but I'm supposed to add some short at 90.50, I typically would not have the add short order out to add risk after hours, but I would have the reducing risk booking profit order out. That's different in the pre-market. In the pre-market, I'm in front of the screen. So as soon as I wake up, if I see that one of my swing positions is trading at a price where I'm supposed to add risk, I will add that risk. I don't care what time it is. My game plan says I'm supposed to be adding risk at this price, so I do it. And the same is also true with reducing risk, and then it stays that way throughout the rest of the day. But what I'm much more hesitant to do in the pre-market is start new trades, which isn't to say that I don't do it. But if I do, I generally, if it's going to be in the pre-market at all, I generally prefer it to be closer to the open because there's just more, you have liquidity problems pre-market. So if I am taking a new trade pre-market, most of the time I'm just taking a feeler. I'm not taking a real size. So if I have a liquidity issue where I can't liquidate the position because there's not enough liquidity pre-market and it's a new trade, my sizing is small enough that it's fine and I don't care. And then I can take real size when the market opens, or I can just wait for the market to actually open and then actually put it on. So again, I don't know what percentage of trading I'm doing after hours. I would imagine it's less than 10%, and the vast majority of that is managing swing positions especially in the early morning on how the early morning gap is occurring. We could be gapping where my game plan says I should be adding or reducing a lot of risk, and I do it whenever it happens. Additionally, if you see bad news in the stock aftermarket, do you just flog it in the aftermarket, or do you wait for the next day and respect your stop? Typically, I wait for the next day and respect my game plan. I'm almost always a believer in the buy the ticket, take the ride idea, and not changing your trading game plan in the middle of a trade. It's a little bit more, again, tricky and nuanced if it's trading through where your stop is supposed to be after hours. But I have separate rules and a separate game plan for what I do for when a swing position gaps past the stop loss, which is not a situation you want to find yourself in. But then I implement what I call the 15-minute rule, which is basically whatever let's say it's a long position and it's gapping past where my stop is supposed to be, I actually don't liquidate the position in the first 15 minutes, which inherently means I have unlimited risk for the first 15 minutes. But my risk is managed through time instead of through price, which is hard to quantify. But then I'll put my stop loss in typically at whatever the 15-minute low is when it occurs, even if it's 1 penny below where it's currently trading. But the 15-minute gives the market the opportunity to flush out panic sellers and create a pivot low that I can then utilize to sometimes even add the position versus and respect the pivot low, and then use that as a more legitimate stop, where if the 15-minute opening low is breaking, you know that there's further continued follow through on selling. So yeah, appreciate all the questions, and I hope that helps. From Robert, what or who is CTA exactly? Sure. So CTA stands for Commodity Trading Advisor. I think that term is a little bit of a misnomer, because a lot of what we're looking at when we're looking at CTA flows is not in commodities, though they are active in the commodity space. A lot of what we're looking at is at the index level. So I think it's a little bit of a misnomer, at least for our purposes. But the way that you should think about a CTA is basically the way that we're talking about it is it's a systematic trend following fund strategy. It is the way to think about it. So they basically add and reduce exposure at the index level based on trend. So as you've probably seen, Robert, because I know you've been following our meetings for a long time, like Goldman Sachs will always provide these SPX pivot levels that they model, that they are, spots to pay attention to, because that could be a spot where all of a sudden the CTAs at that pivot level 1 now have to begin selling if that level breaks, because that, again, think about it as a systematic trend following fund. So if it breaks however it's defining its uptrend, then it's going to begin to sell. But while it's above that, then it's going to buy. So like a lot of the times, not always, but a lot of times when you look at like the CTA estimated buying and selling, you'll see that they are set to buy a certain amount in an up market, and then they might be set to buy a lesser amount in a flat market, and then they're set to sell in a down market. Well, basically what that is they just are adding exposure and adding leverage into an uptrend, hence the up market at buying, or reducing exposure or selling into a down move. So in other words, the uptrend is breaking or the downtrend is coming in. That's not a hard rule. In more extreme market periods, sometimes you will see that CTAs are buyers or sellers in any tape. But they're set to sell less in an up tape than versus a flat tape, and sell most in a down tape, or the opposite in an up tape. But the reason why this stuff is important is because it's such a massive amount of money flow. systematic strategies in the market, and there's several big ones. There's some ARB ones, but we're constantly looking at like the CTA trend ones and the ones that are based on volatility, where as volatility declines, the systematic vol funds add exposure. As volatility increases, the systematic volatility funds reduce leverage and reduce exposure. And then again, those numbers, really smart people have figured out how to quantify. So it's just important information to know that, hey, if the XYZ happens in the market, that therefore leads to this amount of forced selling or this amount of forced buying. So it's just really important information, and then you want to think about that in the context. I like to think about it in the context of $50 billion a day, which I'm sure markets have higher volume days and lower volume days. So not a science, but I heard one time in a podcast with Jem Carson, who I think is great when it comes to this stuff, and definitely someone that everyone should follow. That to think about these numbers within the confines of 50 billion being the total amount of money that moves the market on an average day. So when you think about $50 billion in an average day, and right now I just said we have an average of $10 billion of selling from CTAs alone. That's just one cohort every day for the remainder of this week: Tuesday, Wednesday, Thursday, Friday. Just think about how big that number is on a percentage basis. That 20% of the money flow in a typical day, and I know volume has increased, so it might not be perfectly typical, is selling flow, forced selling flow every day this week. And that's in a flat tape, that number, per the note that I read a little earlier off of Pat's note. So again, that's a number that probably will be less in an up move, and we were up today, more in a down move. But you just using that as a baseline, it's just a massive amount. And again, you can also think about that when we were talking about the positive gamma environment that was $11 billion before the market broke down. Think about that in the context of a $50 billion typical day, where if you go down 1%, it's met with $11 billion of buying. If you go up 1%, it's met with $11 billion of selling. Think about how hard it is to get the market to move more than 1% or even move at all when it's going to be met with that degree of buying on a downside or that degree of selling on an upside within the confines of a typical $50 billion number. So that's how I think about it. For Mike, what do you think of Marvell's earnings? Why it dropped so much? I didn't look at them, but I got him here in the VTF. First quarter revenue. They see first quarter revenue. The range that they give looks like is in line more or less with the estimate. The estimate is at the midpoint of the range that they're providing, so it's okay. Not necessarily good or bad. Sees first quarter net revenue. That was first quarter revenue. They see first quarter net revenue at 1.87 billion plus or minus 5%. So kind of a small beat on that. They beat on EPS by a penny. They beat on their sales. Their EPS guidance, first quarter adjusted EPS guidance is also in line kind of with the range. I'm just looking for something that could be just outstandingly bad in this. And I don't see anything in it. Yeah, I don't see anything outstandingly bad in it. I don't see anything outstandingly good. It seems like a very neutral-ish report. So why is it trading down after hours based on what I just read? I don't know. I don't see anything crazy in it. Would we consider companies like Hudson River, Optiver, or Citadel as part of the CTAs? I don't know the answer to that question specifically, especially when it comes to Hudson and Optiver. I don't know all the ins and outs of their business models, but I'm going to say generally no. But I really don't know. That's also kind of just an educated guess. I don't think that they're necessarily doing that. You know, Citadel is more on the market making side. I don't know. You know, as I say that though, their business is so massive that they could be implementing all different types of strategies. So it might be better to assume that any and anything that exists, Citadel is involved with. Uh, so again, I really actually don't know the direct answer to that. I just see kind of um, the aggregate numbers there, and yeah, that's it. Um, what else? Looks like I got through things on the YouTube. Uh, um, for Pete, it's basically this guy. This is his fund. This is how you spell it. Anyway, what else, guys? Anything else? Otherwise, happy to wrap up what was a little bit of a slower day for me, which I'm kind of happy about. Made a few bucks today. P&L wasn't crazy, but made a few dollars today. Don't got too much to talk about. Traded a little bit less today. It was good. Good little reset, because who knows when the insanity turns back on. All right, well, I'm not seeing anything new, so I will wrap it up there. Have a great night, and I will see you all tomorrow.